Morning, everyone. Welcome back to Morning Kappa at 8. So looking at the Hang Seng Index, last Friday, it underwent a very strong bullish momentum. So at this juncture, the Hang Seng managed to climb above the 20 days moving average, eyeing to cross above the 50 days moving average. So on the downside, the support remains at 25,000 point level. So we'll keep a bullish bias unless there's a bearish breakout on this 25,000 point level. So looking at the Hong Kong market as a whole, we change our setting on the heat map, right, on the weekly turnover and also the weekly performance. You can see that most of the counters does experience selling pressures over the week. Now, except some of the tech names like 9660, Horizon Robots that are bucking the trend, went up by 8%. Xiaomi also bounced off from the multi-weeks low, gained a 3% over the week, right? And the Meituan make about 5% gains over the week. Now, however, the pop mart still experienced selling pressures last week, and it has been coming down since their peak. I think almost 20% corrections. Okay. Um, Nevertheless, right, this week we continue to look at the commodity related counters and some of the such as the gold, right, aluminium, and some of the important metals in the Hong Kong market. As for this morning trading stocks, firstly we have the Horizon Robotics 9660 that they have break past 9 Hong Kong dollar resistance. So after the breakout, we'll be testing the R1 at 950 and followed by R2 10 Hong Kong dollar. Downside support will be at 850. Now, then on we have China Hongqiao 1378, right, which will break past the 32 Hong Kong dollar. So after the breakout, Hongqiao will be testing the 34 and followed by 36 level. Downside support is at 30. Now both counters 9660 and also 1378. 1378 is the Hang Seng Index component stocks, whereas the 9660 is the Hang Seng Tech Index component stocks. Okay, and the S&P 500 initially was positive sessions, but towards the closing after the announced results by Broadcom, right, Avago, the S&P 500 have selling pressure over the week. So right now, this level 6850 has become an interim resistance for the S&P 500. So downside support will be the 6,006 and 6350 will be the ultimate stop loss point for the SPX, right? And I think over the week, one piece of news apart from the Fed cut interest rate, the another news that actually excite the market is that SpaceX is actually confirmed that 2026 they are going to launch their IPO. Market is actually looking at valuations about 800 billion. That will make them the most valuable private company on earth right now, right? So uh, looking at the another counters that actually invested in the SpaceX is actually EcoStar. Since the SpaceX mentioned about the IPO, EcoStar has been actually moving up more than at least 20% over the week, right? As this juncture, the momentum remains strong on the EcoStar. So apart from that, market is also trying to digest the earnings from the Broadcom and also Oracle over the week, whether the AI story is going to slow down. Nevertheless, Amazon right now, it has actually pulled back. Next support level will be at 215. So looking at this price volume profile, I can see that in between this 230 and also 215, this band should be a strong support level for Amazon. So we'll actually pay attention to Amazon at these two levels. Meanwhile, Amazon also invested a stake in the SpaceX. If really SpaceX deliver 800 billion, right, Amazon could fetch about 100 billion valuations due to the SpaceX. Okay. As for the local market, FPM KLCI remains strong over the week, thanks to the performance from the banks and also the industrial sector. So looking at just to recap what we have mentioned so far, right? You follow our morning kappa, right? I do mention to you that the strongest month that in second half of the year will be the December. So if the index were to really actually move higher, right? Two sectors should not absent from this rally, i.e., it will be the finance bank sector and also the utility sector. Of course, telco sector also play another role since the big cap stocks are the index member. And true enough, in this December, right, due to the seasonality effect, right, the December our index have actually went up. Also, recap what happened in between November and December is because there is a MSCI rebalancing activities, right? And this MSCI rebalancing activities will affect countries not the US, but the countries that the US fund managers that invested in include Hong Kong and also Malaysia market, right? So if you follow our morning kappa this year, right, at least we delivered what we have mentioned to you, June, July rally because of the semi-annual revisions. Then on in this December, also because the MSCI rebalancing. And right now, of course, you ask me whether this thing can sustain or not. And after the this uh, December month, we're actually moving closer towards the February month, right? In the month of February, companies are going to announce the uh, Q4 results. And then by the time they announce the Q4 results, that's where the final interim or the final dividends are going to be suggest or announced then. And that will actually lift our market, continue to give a support on our market. So I think that going forward, right, in these 2 months, right, do pay attention to the reports that the research have published, especially those counter that the analyst thinks that they are going to pay special dividends or dividends in the month of February. And looking at the latest Q3 results, right, I think the banks does actually surprise on the dividends, and that's also one of the reasons why FPM KLCI have delivered a very strong performance so far. So I think despite that US market have corrections right now, I just want to also repeat, right, in December month, US usually is a weak month, so US market have a pullback. That does not surprise me, and still looking Malaysia market. I think in this month, likelihood we are going to break the 1645, and potentially, right, if the momentum sustained, we'll be heading towards the another higher resistance at 1685. So over the week, the industrial telecommunications, REIT energies, right, have experienced inflow, right, whereas the property and also constructions continue to experience corrections, selling pressure over the week. So FKLI have moved closer towards 1650. Breakout happens, FKLI will be going towards 1675, downside support 1600, followed by the 1570. At this juncture, we'll set our stop loss at 1600. FCPO continue to experience selling pressures after the MPOB released their November data, right? And so I think this week, 4,000 will be a crucial level. Breaching this psychological support, next level will be at 3,009. At this juncture, we keep our stop loss at 4250. Now, overall, the technical setup remains bearish so far. Likelihood we shall see more bearish breakout on the FCPO. Okay, and over the week, this is the Malaysia's market performance. You can see that Gamuda is the worst performed among the blue chips, and not only it have went down by almost 5.8%, it went down with volume as well. You look at the price volume turnover, right? The Gamuda box is the largest box over the week. You can see that that's the reason Gamuda have dragged the index lower. Meanwhile, index lifted higher over the week by Tenaga, Press Metal, as well as the Maybank and Public Bank, right? So I think that as long as the Gamuda have stabilized and start to actually rebound from a support level, if all these stocks continue to move upwards, I do believe that our index should continue on the upside movement. Now, amongst the oil and gas counters, you can see that whereas Toll have went up by 14%, and PCAM have recouped 6% over the week. That show that these two counters have outperformed their oil and gas peers. Okay, right. Now, as for the trading stocks this morning, we will be looking at two counter. RCE Capital, that's about to break past 1 ringgit and 25 cents resistance. So if breakout happen, the RCE will be travel towards 130 and followed by 135. Downside support is 120. Now, secondly, we have the MSC, right, which break past 1 ringgit and 60 cents. So after the breakout, MSC will be testing the R1 at 175 and then followed by R2 at 185. Okay, and downside support is marked at 1 ringgit and 50 cents. So we have a pending breakout RCE Capital and followed by a breakout stock MSC, i.e. Malaysia Smelting Company. In fact, MSC is one of our jewels stock that we have mentioned in the May. So I'll stop here and pass the stage to Meng on our small mid cap strategy report. Thank you.
Thank you, Joseph. Let me continue with the strategy on the small mid cap, which the report we are publishing in a bi-yearly, right? So basically, what we are looking for, into an FY26, that we believe, it is poised for a potential rebound based on historical trend, as well as that, in fact, that our small mid caps space, based on MSCI's index, is actually one of the weakest performing markets in the region in 2025. We are just behind Thailand, compared to our regional peers. Hence, there is a good chance that we will see a rebound in 2026 based on historical trend. Now, trading below its long-term valuation spread, to the KLCI, there is, we are actually using a 10 years median, spread towards the KLCI for these two indexes. It's actually below, the long-term median. And if you look at, PE wise and on the 5 years, historical, chart, it is close to its mean. It basically is offering a balanced risk profile. And we think, it should be a prime beneficiaries of rotational flows as investors seek incremental alpha, as well as, the fact that catalysts for the large cap names will remain relatively scarce. Ample domestic liquidity should continue to serve as a key pillar of support, as well as market stability into FY26. Now, for investors, I think we advocate a balanced strategy at current moment, combining both value and growth names in the current environment. Now, investors should prioritize earnings quality, margin resilience, cash flow visibility, as well as a certain sustainable yield against a backdrop of elevated geopolitical risks, cost escalations, as well as lingering demand uncertainties in current environment. Now, some of the themes that we believe will continue to play out into 2026 includes, the NETR, the NIMP 2030, Visit Malaysia Year 2026, as well as certain bottoming out laggard plays. Now, there's also, a trend of weakening USD, as well as a potential corporate activities such as restructuring, M&A, and value unlocking activities among the key playbooks that we advocate, in the small mid-cap space. Now, the sectors that we highlight, will potentially do well in 2026 include consumer, constructions, industrial products, oil and gas, technology, and green energy. Now, the key event or, the points that we, may alter our view includes, the US economy undershooting expectations, the strengthening or softening, of overall end demand, geopolitical events, forex, as well as technology trend. I think it's also worth to highlight that in this report, we basically put out the performance of RHP Top 20 Jewels 2025, which we published in May 2025. Yeah, our pick of 20 jewels actually outperformed the broader market with a value-weighted holding period return of 22% since its launch in 14th of May. Now, this is actually significantly ahead of the benchmarking FPM 70 as well as FPM small cap at 0.9% return as well as negative 1.7% return for the small caps. Now, overall, the picks have performed well, continue to demonstrate the strength and discipline of our rigorous stock picking methodology, underpinned by our strong track record in the small cap research. Now we achieve a hit rate of 55%, also again surpassing the overall broader market breadth of the benchmarking indexes. So there are certain laggards, in the 20 jewels, which may also play out, in our team that we believe a bottoming of a laggard place. So do have a look at the report, and that's all from me. I will just pass on to Akef, in the last speaker.
Hi. Good morning, everyone. Today I'll be presenting on our initiation coverage on QS Group. So let me start with a brief background of the company. QS is a regional specialist in inspection, testing, and measurement equipment, as well as materials and engineering solutions. The group operates within two segments, which are manufacturing and distribution, serving a broad range of industries, including electronics and semiconductors, automotive, mining, and also smartphones, and operating directly distribution networks across Malaysia, across Asia, Indonesia, Vietnam, Hong Kong, Singapore, and Thailand, and the Philippines. So QS has over 30 years of operating experience and positioned itself as a one-stop solution provider across manufacturing, distribution, and after-sales services. To date, the group has served more than 3,000 over customers with over 30,000 units of equipment sold across Asia. So most of its customers are multinational corporations across diversified end markets. So importantly, QS-wide regional footprint allows it to stay close to customers, respond quickly to their needs. As of 9 months 25, the distribution segment contributed over about 80% of the group revenue, with the remainder coming from the manufacturing segments. So moving on to the business segments, the distribution segments, which forms of the bulk of the revenue. QS has diversified beyond traditional methodology products into scientific and about analytical instruments, as well as materials for semiconductors, test, and assembly. So the secondly, manufacturing segment, which focuses on automated handling equipment used across over wafer fabrication, including post-probing, wire bonding, and also packaging. So now turning to our investment thesis and valuations of the company. So we initiate a coverage on QS with a buy call of a fair value of 57 cents, implying a 49% upside. So this is based on 23 times FY26 forward earnings, which represents about 40% to the peer average. At the current valuation of the 16 times forward FY25 PE, QS is trading below peers despite delivering a 3-year earnings CAGR of 15.6%. We view this valuation as undemanding for a growing semiconductor production equipment, and also a ATE player, especially one with exposure to the front-end equipment. So looking ahead, earnings growth is supported by MedTech contributions, China collaborations project, and also a recovering semiconductor cycle, which together position QS on a clear earnings recovery and growth projects from 25 until FY27 forward. As at October 25, QS order book stands at 86 million, reflecting early signs of the semiconductor recovery, as well as initial tractions from the MedTech and China-related projects. So the management expect the order book to scale meaningfully in FY26, driven by these three elements that I mentioned: broader semiconductor recovery, the medtech manufacturing, and also the increasing contributions from the China collaboration projects. So so earnings growth for QS is expected to be driven by these three key factors, which is so the global semiconductor upcycle will play a major role as the industry is rebounding strongly. Including the ongoing U.S.-China trade tensions also plays a big role in this, as the China Plus One strategy would benefit Asian manufacturing hubs. QS with established presence across Malaysia, across Asian, would already seeing higher inquiries and order inflows as customers also relocate or expand production within the region. So the second growth would come from the MedTech segment, which is QS also has expanded into the segment by supplying AOI and automation solutions to global medical devices to manufacturers. So this segment carries about structurally higher margins compared to conventional industrial automations. The group has also allocated 30% of their newly Batu Kawan facility to MedTech, about 30% of the floor space. So QS has secured these projects ahead of two locally listed companies supported by its advanced software and also embedded AI capable embedded AI. Yeah. So the first MedTech production is expected to commence operations in first half 26, with multiple confirmed orders already secured. So with management is also conservatively targeting about 8 to 10 tools per year, with an average selling price of 1 to 2 million per tool. So the with the estimated gross margins of about 40 to 50%. So the third one would be the China collaboration project. So QS is also entering the China market through three collaboration projects covering X-ray, microscopy, and wafer handling projects. So these projects will be supported by excess capacity at the Batu Kawan plant, which utilization currently only 10 to 20% compared to 50 to 60% at Zamry. So should demand exceed current capacity, management is open to for additional manufacturing space. So to conclude, we see QS as entering a clear earnings recovery phase, supported by a strong order book from these three segments that I mentioned. So we therefore initiate a buy call on a QS with a fair value of 57 cents, representing a 49% upside, underpinned by a solid growth across over the next 3 years. So that's all from me. So thank you, everyone. Yeah, back to the floor. Thank you.